Hello, welcome to the weekly technical analysis review for Monday, February the 17th. I'm Rafi Barjan at xm.com, and the pairs we're going to be looking at for this week are the dollar versus the Swissy, the Aussie dollar, and the pound yen. So let's begin with the dollar versus the Swiss franc. Looking at the momentum indicators, they're pointing to positive momentum in the short term. Stochastics, though, are in overbought territory, so there is a risk of a near-term correction or consolidation happening. For now, though, prices have stalled around the 50% Fibonacci retracement of the down leg from 1.0022 to 0.9612. So that level comes in at 0.9817. A break above that level could also see prices breaking above the top of the Ichimoku cloud, and that could pave towards the 61.8% Fibonacci at 0.9866. Climbing above the 61.8% Fibonacci would also take prices above the 200-day moving average, would reinforce the current positive momentum, and we could also see the current medium-term picture, which is at the moment neutral, start to turn bullish once again. If though we do see prices reversing lower again, then support should initially come at the 38.2% Fibonacci at 0.9769. Below that is the 50-day moving average at 0.9745. That's also near the bottom of the Ichimoku cloud. So slipping below those levels would risk shifting the focus back to the downside, and then because the prices heading towards the 0.97 handle near the 23.6% Fibonacci before the bears aim for that 60-month low of 0.9612, which we saw earlier in January. Let's now turn to the Aussie dollar pair. It's fairly neutral in the short term. RSI has flatlined, though it is still below the 50 neutral level. The MACD has crossed above its red signal line, but it's still deep in negative territory. So there's still plenty of risks for further sell-offs in Aussie dollar. If that happens, we could see prices initially struggling to hold on to the 0.67 handle, and we have seen the 0.6705 level being tested repeatedly in the past. Further down is that 11-year low of 0.6661, which if broken, we could then see the next targets being the 138.2 and the 161.8% Fibonacci extensions of that up leg from November to December. So those levels are at 0.6647 and 0.6582. On the upside, we would need to see a break above the 20-day moving average, currently at 0.6744, in order for the pair to gain enough sufficient positive momentum to make more sustainable gains, with potential resistance above the 20-day MA coming at the 78.6% Fibonacci at 0.6813. But in order to get a signal that the negative sentiment has been erased, we would need to see Aussie dollar head for the 0.6860 level, the 61.8% Fibonacci, which would take prices above both the 50 and 200-day moving averages, as well as above that uptrend line, which was broken earlier in January. Let's finally turn to the pound yen. The pair is still in a consolidation phase. It's struggling to break above its Bollinger Bands, which have flatlined, further confirming that neutral mode. Prices are being capped by the Ichimoku cloud. We can see prices holding tight within the Ichimoku cloud and the 50-day moving average, which is acting as near-term support. The momentum indicators are kind of mixed. We are seeing potential weakness with the stochastics heading towards a bearish crossover. So we could see the 50-day moving average struggling to hold prices above it. If we do see slip below that level, the next target to the downside could be the 141 handle, which is just below the lower Bollinger Band, and slipping below that we could see pound yen heading towards that all important support at 139.30. So that was a crucial support area throughout October and November of last year. So if that level is broken, that could mark a shift in the medium term picture to a more negative one, with the 136 handle being the next target for the bears. On the upside though, if we do see prices finally breaking above the Ichimoku cloud at 143.63, we could see the upper Bollinger Band being tested just above the 144 level, but really pound yen would need to climb as high as at least the 147 handle to test that 10-month peak from last year in order to signal a resumption of its uptrend. So that's it from me. Thank you much for watching and have a great day.